Thanks for tuning in to the Portfolio Manager. I'm your host Niraj Shah, and our guest today is Rahul Chadha, founder and CEO of Shikra Investments. He's very well known in the Indian circles and the global circles, and it's a pleasure to have him in our studios. Rahul, great having you. Thanks for taking the time out.
Thanks, Niraj, for having me here today.
Yeah, and you know, the perspective that you bring from a global level for assessing risks and thereby people trying to figure out what kind of portfolios can one have, while a derivative of this conversation will be very useful. This may not be as much about a portfolio that you are creating, because I believe portfolios will get created under Shikra over a while, but would love to start off by asking you about how do you see, from your vantage point, the optimism around India at a point of time when the EM optimism is not so high, and the growth in various economies. Again, India kind of stands out because the world may not necessarily have the strongest year of growth in 2024.
So, Niraj, if you look at that framework, see, there is a reason why optimism about India is high, because if you see over the last 4 or 5 years, the policy makers seem to do no wrong. So life is all about making choices, and what we've seen is consistently good, right choices made on a macroeconomic front. And I think that kind of explains why we've seen a lot of optimism. This is the fiscal prudence which the finance minister kind of reiterated yesterday. You look at what happened around COVID, and we got very badly impacted as a country. I mean, there, but still calmer kind of heads prevailed, and the SOPs we gave, the benefits we gave, were limited to the people who really needed it, rather than have huge amount of debt on balance sheet of a country and give handouts for everybody. So I think that was the first mature thought, and the way we handled COVID was good. And coming out of COVID, I mean, the GST collections, and there is a reason why GST collections are so good over the years, because look, the government machinery is implemented GST well. They've gone through multiple iterations. As they say, they've learned fast, they've failed fast, and quickly improved whatever the gaps were there. And that's why we've got the benefits. And those benefits of high GST collections have not been frittered away in short-term gains to win votes, which used to happen in the past, but have been put in gainful infrastructure projects, which have multi-year economic benefits. And I think that's playing out, and that is what globally investors are noticing. And this is happening at a time where we're seeing policy making deteriorate in most parts of the world. It's like, I live in New York and I see what is happening in New York. You look at the US bond yields. Today, when US economy is kind of red hot, piping hot, US is still running a fiscal deficit of 6%. There's a fair bit of an anger in the society on a large amount of population being left out. Look, I consider myself relatively well off, but when I do a $3,000 monthly outgo for health insurance, and still I pray that I don't fall sick in US and come to India for treatment, there is something wrong. And I think that is something which is being done right by the policymakers in India. They're creating the right framework so that the businessmen, whether it's the local or the global companies, come and invest in the country. And I think that is what they've ought to do. Markets can go up and down. Markets can, let's not be too much worried about markets from a near-term perspective. What matters is, are we on the path to become the third largest economy? Are we strengthening our institutions? Are we moving towards becoming a developed nation?
Yeah, most certainly. So tell me, let's kind of divvy up this into two, if you will. And I'd love to know more about Shikra as well. It's an interesting name. Congratulations on that. I really like it. But let's try and think about this from a two perspective. So I'm presuming your firm is not an India-focused thing. It is focusing on various economies in the world, because you have a global role in the past as well in your previous assignment. So tell us, if you were a portfolio manager sitting globally, as you will be or as you are, and thinking of where to allocate, right? Which economies, which countries to allocate, where would how much of this portfolio would be bent towards, say, a market like India, which is growing well, but which is, for lack of a better word, expensive relative to everything else around, comparable?
Yeah. So let me first kind of talk about Shikra at the genesis. And look, I left my previous firm end September, and there was this time to think about what one wanted to do. And when I came with this name, Shikra, being in New York, most people said, look, it's going to be hard for Americans to pronounce. Why don't you have a mountain, a tree, or some forest together? And my point was, look, I'm very, very proud of my Indian heritage, and I want something which reflects that. So Shikra is a Sanskrit word, which stands for peak. And as we know, in markets are going to be tough, and those mountain peaks or those top of the whatever spires of the temples, etc., were always a vantage point to see the approaching enemy. So that's what Shikra stands for, the peak, which is a vantage points for markets, and that's where it is. The way we look at the whole structure is, I, along with some senior colleagues, I'm going to be in New York, but look, every 3 months I'm some part of Asia, whether it's India, Hong Kong, Korea, etc. So I'm constantly traveling. We will have team in Hong Kong, seasoned professionals, which will give us on-ground sense insights of what's happening in China, Korea, Taiwan, etc. We'll have team in Mumbai. So it's going to be a truly kind of an global asset manager. And the hope is, which is what we were discussing before, that when we grew up, when we came in the industry, the top names in the asset management business globally were of the Western lineage, the European names, the American names. The idea is to build something which every Indian, every Asian is proud of. Hopefully, this is just the beginning of the dream, but look, the intentions are good, the values are high. As they say, luck favors the brave.
Yeah, most certainly. So, well, and I'm sure it will turn out well with your experience and with the team that you're talking about. And therefore, I'm trying to peek of it further into it. How would you, therefore, because you have the option of investing, or because you will have the option of investing across the world, if you will, what would an ideal global portfolio look like if you were doing this right now?
So we would start with the emerging markets, or I would say more specifically Asia fund. So India is a market we've liked. There are times the market goes through this periods of overvaluation. As we sit today, probably that portfolio or exposure to India would be 20-25%. This is a market we like from a medium longer term perspective. Look, there is a bit of a slowdown in the economy. We've seen soft numbers. I think the numbers for next quarter would be also soft. Liquidity is tight. Government capex into the elections is going to slow down. Some of the clamp down on unsecured lending may hurt the economy from a discretionary consumption in the short term, but kind of prevents a bigger bubble from a medium term. So I must congratulate, and I'm fairly appreciative of RBI being such a proactive kind of an institution doing these measures. So India is a market, like the way I said, from a medium term we like. Outside that, I think in the second half there is an opportunity in China. That market's been almost written off by the market participants, and what we are seeing is authorities clearly wake up to the fact that deflation is getting entrenched in the economy, and they've reached that stage where they'll do whatever it takes to revive the economy. And I don't think the market participants have priced that market for that, or are baking in that situation. So I think there is an opportunity which may come in Chinese stocks, and these stocks can rally 30-40%. Though I think one adjustment which is pending in China is the renminbi adjustment. So highly likely that with PBOC focused on increasing domestic liquidity over currency, what we may see over the next 6 months is some slippage in the currency. I won't be surprised if renminbi goes to 8, etc. But I think that is the time to go all in China, and that's there. So that is going to be the true bottom for the emerging markets. So if you look at, we are looking at Hong Kong, China to be anywhere between 25-30% of a fund. You look at India, 20-25%, that's 55. There are opportunities in Korea, Taiwan, with what is happening in the AI space and AI going mainstream, with each and every organization kind of wanting it as a priority item within what they're doing. There's a great amount of opportunity which comes in Taiwan to play the AI story. Korea also, the likes of Samsung, etc., attractive. Some of the Korean automakers, they trade below book, 3-4 time P. These guys are the top 3 in EVs, great model lineup. We see how well Hyundai, Kia are doing. I think those are opportunities. And then finally 20-25% comes in ASEAN. That region has not done well, but as the global recovery comes towards the end of this year, next year, markets like Vietnam, Indonesia, and Thailand should do well.
Okay. So some people are making, and just before we take that break, because on the other side of the break, we'll try and talk about India in a bit more detail. But there have been few thoughts expressed over the last few days that for EM funds to get in money, and some EM funds have shut down, some EM funds are kind of trying to be a bit careful. But for money to flow into EM funds and thereby to India, it is imperative for Chinese markets to find that bit of interest as well. Else flows into other EMs too, and EM as a pack might struggle. Would you believe that to be the case?
So I think that is important. See, China is close to 35% of EM benchmark, and if the market, which is 1/3, does well, obviously the funds get allocation. And let's also understand, in US, you had the top 5 names do so well last year that's kind of took away a lot of capital away. But I think a lot of the good news is in the price for those names. With rate cuts happening in the second half, dollar is going to peak. That is always good for EM. With all the likelihood of Trump winning elections, something which US has and doesn't really appreciate for last 5 years, the policy predictability. I think there are going to be questions raised on that. So businesses are going to be reluctant to put large sums of capital if they don't have clear visibility for the next 5-10 years. And I think that's where markets like EM benefit, that from a relative basis, the US exceptionalism which was there may not look that exceptional post the election. So that's what our hope is.
Okay.
Or
so
I would say that's what we kind of think would happen. Yeah.
Well, relatively EMs might look better over the next 12 to 18 months, and there are fundamental factors for that as well, as you said. Okay, stay on, Rahul. Take a very quick break. Come back, continue your conversation on the portfolio manager. Since it's a portfolio manager show, we'll try and focus a bit more on portfolios and how would Rahul Chadha think of having a portfolio in India if he was purely running an Indian theme. We'll come back and try and do some bit of conversation around that. Stay tuned. All right, back with the portfolio manager right here on NDTV Profit, and it's a slightly different version of portfolio manager because in the first half, we've tried and asked our guest Rahul Chadha, founder and CEO of Shikra Investments, about how does he think about India within a global portfolio. We've gotten that idea. He would probably allocate about 20-25% of his money or his wealth into India, and he's hoping for an EM, not revival, but interest revival, if you will. Which is kind of low right now because of what China is doing. Now, Rahul, I hope I got that right.
Yep, absolutely. Okay.
Now, let me try and ask you that if you were in this segment about if you were running an India scheme alone, how would you think about that? Because there are a lot of sectors firing. India is promising growth, but it's also a world which is kind of cagey on growth, and therefore it will have an impact on what happens to any market, including India.
Yeah. So, Niraj, if we rewind, early last year was a very attractive time. In fact, what we were doing was when everybody was excited last Jan-Feb about China reopening, we were taking some money out of China. And there was this Adani episode where you got good entry level in India. We were adding to it. What we saw was as this narrative of inflation peaking gained ground, we had a huge run-up which happened in markets from April onwards to now, and I think most markets took a breather. September, October, India had its own peculiar rally in this. Some of the names we were discussing, small mid-cap names, etc. And regionally, there was rally in all these AI names. So I think that part of the market looks frothy. Some of the mid-cap names which we've liked in the past, the hospitals, real estate, look a bit stretched. Ideally, one would like 15-20% pullback in that. So if you're asking me to deploy capital, I'll probably deploy only half of my intended capital in these mid-cap names. But these are the themes which over next 5-10 years would be multi-baggers. So if you ask me how would I create a portfolio, banks still would be about 25-30% of the portfolio. Look, we were always historically inclined towards private banks, but why one was not looking at public sector banks was because of the frequent government intervention in that. See, you got to give credit to the current government that look, they've not intervened in the working of the public sector enterprises. They become fairly competitive. The leadership there is appointed on a fairly meritocratic basis. So there is a case. There is a case to look at some of these well-managed public sector banks, and I think that's an opportunity. Though these names have done well, but on pullbacks one can evaluate. So private sector banks obviously remains core part of the portfolio, but probably add 15-20% in that banking allocation to some of the public sector banks. So I think that's kind of we've always had SBI, but yeah, one would kind of go out and add some more names over there. So that's I would say a slight change in the view for that perspective. Outside that, industrials is something we've liked, so continue to add to those names. I think real estate historically it's at least a 5 to 7 year cycle. We are in year 3 of that 5 to 7 year cycle. You look at the market caps, despite these names doing well from the COVID lows, they still have a long way to go. The market caps are not that huge, so there is an opportunity in all this time. We were playing the whole basket, DLF, Sova, Prestige, continue to kind of like these names. Hospitals is something we've liked. We've not seen the revival of medical tourism to the fullest extent. I think that picks up in the next couple of years, and a lot of these hospitals have also learned their lessons. They're doing smart brownfield expansions. There are no huge greenfield expansions, etc. So that's attractive. One sector which kind of emerges because of what the government's focused over recent months is tourism, most of domestic tourism. So I think that's a big story, and that takes care of this whole youth unemployment which we have in the country, this need to create 10 million jobs, as they say, which in today's AI world
it's difficult.
It's genuinely difficult. So I think that takes care of a lot of the issues if we do that. And
can you explain that?
Look, again, in any country we've seen, so tourism creates huge amount of jobs. It's a service industry. It's a service industry, and how much would you automate over there, the restaurants, the hotels and everything? So that creates job. And look, at the end of the day, people would have spare time, and rather than go out and spend that money outside the country, it creates a huge multiplier effect if that money is spent in the country. And we've seen after nearly 15 years, we see the capex pick up in the hotel industry. So I think that is where it is. So the airports have been built. So I think that is a space one would look at for next 5-10 years. And I think that kind of an story lasts much longer. So tourism, again, hospitals, real estate, industrials, financials. These would be interesting stories.
Nice. Can I ask you about what within, let's say, I'll start with the last first, then go on to banks as well, because PSU banks is an interesting piece. Because you bring that view that a typical FII might have, right? Yeah. So how would a large FII like yourself, for example, look at playing, let's say, tourism? Because it's a sector with a lot of offshoots, but none of the offshoots have significant large cap presence, right? So how does a money bag like you play that theme then?
Yeah, so we were kind of exposed to some of the hotel names, like something like a Lemon Tree. We were anchor investors. So you went through that period where COVID hit them bad, and we were playing along with the promoters that look somewhere it comes out of it, but they've done a great job. So I think those prayers worked, so hats off to them. So I think that's there. You've got options like Make My Trip, the OTAs, etc. So all those things are there. And look, what would happen is in due course, as you have the structural growth stories revive in the sector, more companies would come for IPO. So you will get the stocks. It's really a function of the growth and the opportunity set, and you'll get the names. There are some resorts listed here and there, but they are small market caps. But hotels, some of the OTAs, airlines are a good way to play. Airports, I think that is where it would come. We've seen a huge run up in some of the listed airports, so one would like to get them cheap, but I think such is in the situation with most good names in India.
Yeah, you can argue, yes. Okay, and well, there is probably one pure play listed name and the other one which will, as per a note recently, will get listed in a few, but otherwise we don't have too many plays there. But yeah, the point is well taken. Okay, the other aspect is PSU banks. The bulls make an argument that even if you think hard about which large default could happen in India over the next 12 to 18 to 24 months, you have to think really hard, and still might be difficult to come up with a name. So asset quality, which used to plague PSUs in the past, have not. You also made this point about interference, etc., which is also coming. So my question to you is, do you reckon that there is a case that PSU financials can trade at a much higher average valuation over the course of this decade than what they have in the previous decade?
So, Niraj, I'm a strong believer in market cycles, and we've seen, and being in market for 25 years, we've seen those cycles. And typically, these are 8 to 10 year cycles. So, I jokingly tell my team that we sell hubris and we buy humility. And that is where you make money. I still remember when we bought real estate in September of 2020, even the management was surprised. And I like, boss, you're putting on the best behavior. You are deleveraging. You got best systems in place. You don't want to buy land bank. This is the time we'll make money. And then after 7-8 years of cycle, when you go back to land banking, is the same old story plays out. So to that point, if you look at where has the excesses happened in India, it is unsecured retail credit.
Got it.
What does every NBFC want to do? Unsecured retail credit. So that is where you've got to stay out. That is where valuations will contract. That is where you will get negative surprises. The PSU banks call them that, I won't call them bit sleepy, but they were slow to come to this, and that is where they get saved. And on the corporate lending, I think things are in fine fettle, so it doesn't look like that you're going to have large accounts which go delinquent, and they've got a decent liability franchise also.
Sure.
So that kind of helps. So I think they can go anywhere, let's say between 0.7 to near book, etc., and that's where the upside is. So obviously you don't go too much down the curve. Look at the top 2-3 PSU banks, and I think that's where
they are above one book, so to say. You expect that could happen too. So therefore they need to trade at above average valuations, except one maybe. You got to trade at above average valuations to the past decade, right?
Yeah. See, what happens is when you have a strong tailwind, stocks would trade. It is really a question of, do they trade at, let's say, 1 standard deviation above, or do they trade about 2 standard deviation above? And there's a reason that they may trade above average valuations, because last 7-8 years what we've seen from the government is very positive for these banks.
Sure.
The macroeconomic stability is very positive for these banks.
Sure.
So I think that kind of helps them.
Point well taken. Before we wrap up, because out of time completely, but just would love 60 seconds if you can, could there be a similar case made for public sector enterprises at large? I know it's wrong to paint that with the same brush because there are various sectors and people play sectors and not necessarily the owner. But I'm just trying to understand, because this government is making a difference at various pockets. Do you like other PSU bets? Because they've been the rank outperformers in the last 3 to 6 months.
So I think somewhere that's playing out. Out, let's say in utilities and maybe somewhere OMCs. Look, there is a bit of a froth also. There is a bit of a froth in some names which are trading at whatever 5-6 times book, and valuations you see beyond 20-25 times. So it's not that everything is attractive, but again, there is operational efficiency. There is, again, somewhere we can say the swing in the walk, all these right things being done by these PSUs, etc. So one can look at these PSUs in particularly what we like is the power generation, the power transmission space, etc.
Yeah, so my final point, Rahul, just trying to understand, again, because you are an FII, right? PSUs probably were an untouchable in the last decade, if you will. Very few people would go for it. You believe that is no longer the case?
Yeah, I think with the governance improve which has happened, and a large part of PSU governance is determined by what priorities the government has. And with the governance improvement which has happened, I think FIs would look at it.
Okay. Viewers, this is an important view because Rahul Chadha wears his Indian lineage on his sleeve. Very proud of that. But he's a large FII voice, and therefore it's great to get a perspective from him on the portfolio manager about how he thinks about portfolio construction, because that is how typically a foreign institutional investor would think about it. And I think in some of these conversations, some of these answers, you've told us a lot more than I was hoping for. So Rahul, thanks a lot for taking the time out and coming to our studios, more importantly.
Thanks, Niraj, for having me.
The pleasure was ours. And viewers, thank you for tuning into this episode of The Portfolio Manager.